On March 12, 2026, Chinese authorities quietly halted exports of refined oil products that had not yet cleared customs. No press conference, no diplomatic statement. The official explanation was administrative, a routine logistics pause. The capital flows did not treat it that way. Within hours, energy traders in Singapore and London were pulling up models they hadn't opened since 2022. Tanker tracking analysts at KPLR and Kairos began logging anomalies. Inside certain intelligence services, phones started ringing in the middle of the night, because what looked like a paperwork delay was actually a signal. Beijing was reading the same maps Washington was reading. And it didn't like what it saw. The U.S.-Israel campaign against Iran had entered its third week. Operation Epic Fury had struck military infrastructure across more than 20 of Iran's 31 provinces. The Strait of Hormuz was, as of March 11th, effectively closed to commercial tanker traffic. And somewhere in that chaos sat a fact that almost no Western analyst was discussing out loud. China needed that oil. Here's the problem. Beijing and Washington are not simply on opposite sides of a Middle Eastern conflict. They are, right now, in direct economic collision over the same burning infrastructure. And the side with more to lose may not be the one currently dropping bombs. Start with the numbers, because the numbers are the story. In 2025, China imported a record high 11.6 million barrels of oil per day. Of that, roughly 1.38 million barrels per day came from Iran, according to the tanker tracking firm Kepler. That is 12% of China's entire crude supply. The Chinese government's own customs agency officially records 0 Iranian imports, because almost all of it arrives relabeled as Malaysian, Indonesian, or Omani crude, processed through a shadow fleet of approximately 500 tankers that use falsified GPS coordinates and rotated vessel names to evade detection. China didn't stumble into this arrangement. It built it deliberately over nearly a decade. When the United States reimposed sanctions on Iran in 2018, China's major state-owned refineries stepped back from direct purchases to limit sanctions exposure. The gap was filled by a network of small independent refiners in Shandong province, known in the industry as teapots. By 2025, these teapot refiners accounted for an estimated 90% of Iran's oil exports to China. China's largest trading houses act as intermediaries. Hong Kong front companies register the trades. The oil's origin is masked. And Beijing maintains plausible deniability while saving, by some estimates, $8 to $10 per barrel off the global price. Over 90% of Iran's entire seaborne oil exports go to China. China is not merely Iran's customer, it is Iran's only customer. And that mutual dependency has been hardened into concrete and steel through the 2021 Comprehensive Strategic Partnership, a 25-year cooperation agreement in which China pledged $400 billion in infrastructure investment in exchange for guaranteed discounted oil. Ports, railways, telecommunications, surveillance systems. China has been building inside Iran for years. The Tehran metro runs on Chinese engineering. The internet shutdown that the Iranian government deployed during January 2026's internal massacres operated on infrastructure that Chinese firms constructed. The surveillance technology used by the IRGC to track dissidents was supplied by the same companies that do identical work in Xinjiang. This is not a transactional oil deal. It is a structural embedding of Chinese interests inside a country that is currently being bombed by the United States. Here's where it gets dangerous. Let me show you how this plays out. A Chinese oil executive needs to ensure that 1.38 million barrels per day continue flowing into Shandong's teapot refineries. The Strait of Hormuz is closed. Iranian oil facilities have been struck. The Shadow Fleet's tankers are claiming to carry Chinese crews, in some documented cases actually doing so, in a bid to deter Iranian attacks on shipping. Chinese spy ships, including the Dayang Yihao, are shadowing U.S. carrier strike groups in the Arabian Sea, feeding intelligence about American movements back to an ally that is trying to survive. Now take it one layer deeper. China doesn't just need the oil, it needs the route. Iran is the connective tissue of Beijing's Belt and Road Initiative across the Middle East. The Five Nations Railway Corridor, when completed, will connect China to Iran via Central Asia and Afghanistan, running 50% faster than ocean routes and entirely bypassing U.S.-dominated maritime choke points. The port at Chabahar on the Sea of Oman is China's alternative access point to the Persian Gulf when Hormuz is closed. If Iran collapses, or is occupied, or is transformed into a U.S.-aligned state, the entire overland architecture of Chinese strategic logistics dissolves. This is the calculation that almost no Western commentary is making explicit. The question isn't whether China will defend Iran militarily. The question is what Beijing will do to make sure it doesn't have to, and what actions, short of open warfare, it has already taken. In July 2025, China delivered HQ-9B air defense systems to Iran as part of an oil for arms arrangement. In the summer of 2025, China delivered HQ-16 and HQ-17AE surface-to-air systems to help rebuild Iran's defenses after the June 12th day war with Israel. China also supplied loitering munitions, continued transferring ballistic missile components and carbon fiber materials for missile production, and, according to intelligence reports published on February 27, 2026, sent loitering munitions to Iran shortly before the February 28th U.S.-Israeli strikes. Negotiations for the CM-302 supersonic anti-ship missile, a system capable of threatening any vessel in the Persian Gulf, were described in February as close to completion. None of these actions required China to fire a single shot. And yet, here is the piece that does not appear in the diplomatic readouts. China's 25-year cooperation agreement grants Chinese companies access to Iranian ports, bridges, railroads, and critical infrastructure. That means there are Chinese personnel in Iran, engineers, technicians, project managers, people building things, operating systems, maintaining hardware that is now, in some cases, inside a declared conflict zone. In early March 2026, Chinese state media reported that over 3,000 Chinese citizens had been evacuated from Iran. But evacuation implies not everyone left. And history offers a template. In the South China Sea, in Sudan, in Myanmar, in Pakistan's CPEC corridor, China has demonstrated a consistent playbook when its infrastructure investments face physical threat. It sends private security contractors, described as civilian personnel, to protect assets. It embeds technical advisors whose presence creates political facts on the ground. It draws a line, quietly, around what it considers its property. A Beijing that has formally pledged $400 billion to Iranian infrastructure, that has built the surveillance architecture running Iran's internal security state, that has sold Iran air defense systems and missile components, and that is receiving 90% of Iran's oil exports, does not watch that country get dismantled without calculating its exposure. The pattern repeats. Assets go in, then the people who protect assets go in, and then the people who protect those people go in. No one in Washington is publicly tracking exactly how many Chinese civilian contractors remain in Iran right now. That silence is the signal. Here's what the economic models aren't pricing in yet. In the base case, the Strait of Hormuz reopens within 2 to 3 months. Iranian oil slowly routes through overland corridors, and China manages the gap through its existing stockpile. As of March 2, 2026, China held 1.39 billion barrels in storage, according to Keros' geospatial analytics, representing roughly 120 days of net crude imports. Chinese national oil companies had already planned to build at least 169 million barrels of new storage capacity through 2025 and 2026. In the base case, Beijing absorbs the disruption, accelerates its renewable build-out, and emerges with slightly higher energy costs but no structural crisis. Brent oil stabilizes in the $80 to $90 range. The Iran shock is a margin issue, not a solvency issue. In the stress case, the strait remains closed for 6 months or more, and U.S. secondary sanctions targeting Chinese teapot refiners escalate sharply. Washington has already sanctioned multiple Chinese entities in this network, and the Treasury has demonstrated it is willing to move. At this point, the 1.38 million barrels per day gap becomes real. Saudi Arabia and the UAE can reroute approximately 5 million barrels per day to avoid Hormuz, some of which flows to China, but at global market price, rather than the $8 to $10 per barrel discount China currently enjoys. But China's energy import bill increases by an estimated $20 to $25 billion annually. Shandong's teapot refiners, operating on thin margins, face insolvency or consolidation. Beijing's downstream petrochemical sector, already managing weak domestic demand, faces feedstock compression. GDP impact, a drag of 0.3 to 0.5 percentage points. The tail risk is the one nobody wants to model. In the tail scenario, U.S. secondary sanctions escalate to primary sanctions, targeting China's state-owned banks that clear shadow fleet transactions. This is the financial equivalent of an undeclared economic war. The dollar clearing system, which still underpins roughly 60% of China's international trade financing, becomes a weapon pointed at Beijing. China's response, drawn from its existing playbook, is to accelerate de-dollarization, push oil transactions through its cross-border interbank payment system, and potentially retaliate through export controls on critical materials where it holds dominant market share. The non-obvious second-order effect that most commentators will miss is insurance repricing. Lloyd's of London and the major P and I clubs are already classifying the Persian Gulf as an extreme risk zone. Shipping insurance for tankers transiting within 200 nautical miles of the conflict is reportedly running at 5 to 7 times normal rates. That repricing does not go away when the shooting stops. It gets structured into freight contracts for the next 3 to 5 years, affecting every product that moves through the Gulf regardless of origin. And since roughly half of China's crude imports and nearly a third of its LNG imports transit Hormuz, the freight cost increase becomes a permanent embedded inflationary factor in Chinese industrial production for years. The directional verdict is this: China's energy exposure is real but manageable in the short term. What is not manageable is the strategic architecture it is losing in real time. By mid-2026, if the current conflict trajectory holds, China's overland belt and road corridor through Iran will be functionally inoperable. The port at Chabahar will be either damaged or politically inaccessible. And the 25-year partnership, which Beijing sold domestically as proof that it could build a parallel world order immune to American pressure, will have been demonstrated in front of every global South government watching, to offer no real security guarantees when American military power decides to act. By 2027, the shape of what happened in early 2026 will be clear. Either China found a way to signal a red line that Washington acknowledged, in which case a new informal understanding governs what the U.S. may and may not do to countries that Beijing has structurally embedded itself in. Or China failed to signal that red line effectively, in which case every government in the world that has accepted Belt and Road investment understands that Chinese partnership does not equal Chinese protection. Both outcomes reshape the next decade of global order. Here's the convergence point. The Iran conflict is not primarily a Middle Eastern story. It is a test case for whether the world's second superpower can protect its economic architecture against direct American military disruption of its partners. That test is running live right now on global television, and the result will be studied in every capital from Caracas to Jakarta. For Washington, the temptation is to read Chinese restraint as weakness. That reading may be dangerously incomplete. China is not restraining because it lacks the capability to act. It is restraining because the current moment does not require action. Its spy ships are already in the Gulf of Oman. Its satellite constellation, exceeding 500 spacecraft, is providing Iran with near-continuous optical, radar, and signals intelligence. Its encrypted Beidou 3 military navigation signals have replaced GPS in Iranian missile guidance systems. China is not absent from this conflict. It has simply found the altitude at which it can operate without triggering a direct response. There is no good option here. Only trade-offs between different types of collision. If the United States escalates sanctions enforcement against Chinese entities facilitating Iranian oil trade, it risks a financial confrontation with an economy so intertwined with its own supply chains that the damage is mutual. If it does not escalate, it accepts that the shadow oil economy funding a sanctioned adversary will continue operating with impunity. If China moves toward more overt support for Iran, it risks the bilateral relationship with the U.S. that still underlies trillions of dollars in trade. If it does nothing, it loses the credibility that makes the Belt and Road a viable offer to developing countries. This is the world being built right now, not in dramatic fashion, but through tanker transponders going dark, through construction for oil exchanges logged in Hong Kong intermediaries, through satellite passes over carrier strike groups, through civilian contractors whose presence creates facts that no one wants to name. The Chinese intervention isn't coming, it's here. Most people just haven't noticed yet. If you're watching this, you understand something most don't. The next world war may not begin with a declaration. It may begin with a logistics decision, a tanker reroute, a contractor deployment that nobody officially reports. Subscribe to stay ahead of the stories that actually matter, because the next episode reveals something even more unsettling. Next time, the Beidou trap, how China's GPS alternative has quietly embedded itself inside the weapons systems, shipping lanes, and financial infrastructure of 120 countries, and what happens when Beijing decides to use the off switch, because the world's most important navigation system isn't American, and most people don't know it yet. The silent war continues. The question is whether you're watching or just waiting.